So when you look at this page 2, look at the year your parents were born.
1950.
If they would have put in $10,000 when they were born, it would now be 10 million. And if they would have put in around 100,000 or so when you were born, it would now be 10 million. And that is the years of compounding. And what this chart shows is it doesn't matter which party controls the White House, because that's what everybody wants to talk about. What if this person gets elected, or what if that person gets elected, and blah, blah, blah. And no matter what happens, 50% of people are still going to be angry. The president doesn't much matter. It's like the CEO of a company. You can only do what the board allows you to do, which is Congress. Okay? So there's not much else. And that's why the current administration is having a hard time spending more money, because the Congress has not approved it. So there's things that's going to go on, but ultimately, you know, we've lived, America has lived through stressful times before. It's not that bad. It was really bad during the Civil War, because your cousin might have been on the other side and you were shooting at him. Right? This is what happened between the North and the South. This ain't that bad. When we were young, our government shot at people because they were protesting in college, and people died at Kent State. It's not that bad, right? Yeah, people are shooting each other, but they're not shooting each other over political beliefs anymore, right? They're only shooting each other for other things, right? I don't know, 2 a.m. in the morning, I don't know, whatever. There's all this weird stuff happening across the country. So the White House does not much matter in terms of party, okay? Next page. This is the long-term goal and what you should do over time. We tell people the red line is the long-term goal. Stay in a well-diversified, balanced portfolio over time and it will grow. And your ultimate goal is to be the green line, is to get to your enough number, or get to that retirement number, or whatever that number is. That green line represents taking out 5% a year. And if you stay in that balanced portfolio and you take out 5% a year, yeah, it goes up and down, but ultimately, it still goes up. You got to spend over 8% for that number to start going down. So the question starts to become, right, all of us can make the perfect financial plan if you can tell us the exact day you're going to die, and we can make sure on that day you don't have nothing. But that's not what people typically do. But remember, if you spend only 5% and you stay invested in a balanced portfolio, the account will still grow over time. Okay, next page. Bottom right. 100% bond portfolio has a risk factor of 3.4%. The average return for bonds over the last 70 plus years has been about 5.6. If you stick to the right hand side and you go up to the next green dot at 3.3, what you'll see is risk was reduced by 0.1, and the rate of return went up to went up by 1.7 to 7.3%. The next increment of risk increase from the green dot to the yellow dot goes up 1.3, and rate of return goes up by about another 1.7. So what you'll see here is that on average, a balanced portfolio of stocks and bonds gave about a 9% rate of return over time. I am hopeful that going forward, the average rate of return will start to go higher, because we've just come out of a decade where fixed income basically paid you nothing, right? So it'll be easier to make money. The next increment of risk, that 4.6 in yellow, goes up to 5.8, so you see it's an increase of 1.2, but look at the rate of return to the left of that. It only goes up by 1.1. So the best return you can get for an increment of risk is between those yellow dots. And this is why we run Global Balance. Not because it has the best return, it's because it has the best rate of return for an increment of risk. And basically, over any 5-year period of time, there's never been a negative portfolio or negative rate of return. So if you don't intend to spend your money for the next 5 years, it's pretty comfortable to assume that you're not going to have any less money in 5 years. And hopefully we'll get closer to that 9% rate of return. Okay, next page. This is the economic scorecard that JP Morgan produces once a year. And basically, if you look at the thumbs, growth is up, jobs are up, earnings growth is okay, it's pretty good. Thumbs not pointing down. Inflation's pretty good, it's coming down up until yesterday's report. So, but it's still 3.5, it's not 9 anymore. If you look at interest rates, yeah, it's up, but the velocity of any future interest rate increases is probably negligible. And if you look at the next one where they talk about risk, as people look at risk as rates going up and making things tighter, you hear a lot of talk about it coming down. And so that's why when they look at risk, everybody looks at risk coming down because they think at least the rate increases are over. Okay? And then when you look at investment opportunity, it looks pretty good because, for the first time in a decade, bonds don't look that bad, right? It's not like you're making zero anymore, so it's good. Next page. As we said last year, we do not believe interest rates will come down. We also don't believe rates will go up a whole lot more anytime soon. If we do get a rate cut, it'll probably be 1 or 2, and it's not going to be much. And the reason is inflation is too high, not too low. When you look at this 2% target the Fed has had that you hear in the news, they're starting to soften their language. They used to say when we get to 2%, we'll start lowering rates. Now you started to hear as we approach 2%, we're going to lower rates. Now you're hearing, so long as inflation trends downwards, we may loosen rates. So they're backing off what they said. But if they did stick to this 2% target, the 2% target's not happening because of the next 4 items. Monetary policy is tight. What monetary policy is if you want to go borrow money, it's tight because it's expensive. The more they raise rates, the tighter it becomes because it becomes harder and harder to get at the money. Fiscal policy is still easy. The government's spending too much and they're borrowing it all. Okay? So that's inflationary. They still have too much money in the system. Unipolar, multipolar world, geopolitical competition, war, and everything else is inflationary. Iran, Iraq, Russia, Ukraine, China, Taiwan, Israel, Hamas, all these other things, all this war, everything that gets blown up is going to get replaced. It's going to take away resources from other places that could have better been spent on something more productive. But as long as these things continue, it is inflationary. Deglobalization. Everybody wants everything in their own country. I don't want my microchips in China. That's how come I couldn't get my new phone last year, right? Also, whatever else is happening. Everybody wants everything back in their own country, whether it's pharmaceuticals, technology, food supply, yada, yada, yada. We no longer are concerned so much about being close to the cheapest cost of labor or close to the raw materials because everybody wants convenience now. I want it when I want it. So it has to be in our country because I don't want to have to go ask the Chinese for it or whatever else it is. So what's happening around the world through this deglobalization that we've been talking about for over a decade now, countries are starting to look inward. They're not looking outward anymore. Everybody wants to bring everything back. And whether it's the rise of Trump or the Brexit in the UK and all these other things, these are all signs of deglobalization. People want things for their own country now. And so that's what this deglobalization is about. This economic and social disruptions, whether you look at the things or the climate change issues, or you want transgender bathrooms everywhere and other types of things, these all take up resources for a small population that believes in whatever they believe in. And as you take resources and do not use it for the masses, this is inflationary. And so as these social issues continue, it does not help inflation. And because of all of these reasons, we do not believe we're going to get to this 2% target. Okay? The other social thing, you got minimum wage going up, right? You got all these other things because of living wage and all these things, right? So, anyway, next page. First column. Second item down is the net interest we pay on our US debt. It has now crossed 13%, and when this gets updated in the next month, it will now cross the entire defense budget. We pay more interest on our debt than the entire defense budget. That number will cross 14% and go to 15 or 16 by year end. And last year when I showed you this chart, it was at 5. Above that is other, and other is the discretionary spending that comes out of Congress. When you combine the interest payments and congressional spending, it's 100% of what we borrow. We do not need to borrow more money to pay your Social Security payment. When you look below in the first column, you see that Social Security cost about 1.4 trillion. And when you look at the second column and you see what we collect from social insurance is 1.6 trillion. That went up $100 billion last year. Because everybody working got a raise over the last 3 to 4 years of about 15 to 20% because of inflation. Everybody on Social Security got a raise of about 15 to 20% because of inflation. And because everybody's getting more money, you got to pay more into Social Security. So the reason they got to borrow more money is not because of Social Security. And if you look at the total budget of 1.5 trillion this past year, the current administration has introduced their current budget of $8 trillion. So if the government continues spending like this, it will keep fueling inflation like I talked about earlier. Okay, next page. This is wages and employment. The average unemployment going all the way back to over the last 50 years is about 6.2%. The 4% line is full employment. We're still below full employment. I mean, so we're well fully employed. We don't even have average unemployment. And if you look at the wage increases over the last 3 to 4 years, yeah, it's in excess of 20%. So when you look at the consumer, it is absolutely true. They're spending more money, credit card debt is up, all these other things. I think we just recently crossed delinquency rates pre-pandemic. But when you look at their debt payments relative to their income, it continues to drop. So what we think is the consumer's not spending all of their raise. And we think it's because during the pandemic, a whole bunch of people had to save money because they couldn't find any place to spend it, right? You couldn't go any place because everybody was closed. You went on Amazon and everything you wanted was already sold out. So you saved money. And when everything opened up and you could go spend money, we think there's a good percentage of the population that said, hey, having extra money in the bank feels pretty good, and maybe it's become a habit. And maybe that's why debt to income is dropping, right? We'll see. Next page, bottom right. Every segment of the market is more expensive than average. It's not just the Magnificent Seven or the Fab Five or whatever else it is. It's just every part of the market is more expensive than average. So let's think about the word average. To get average, there's got to be a whole bunch of data points above average and a whole bunch of data points below average to get average. Okay, so we're in this period of time where it's above average. Not surprising, because earnings are so good, because people are willing to pay the higher price even though they're still complaining about it, right? You know how much I had to pay for this? Well, Auntie wouldn't buy crackers yesterday at Whole Foods because it's $14 a pack. So she bought me a baguette at $3.50. So it was pretty funny. Next page. Top part of the chart. Look at the right side. This is how long we've been above the median. Look at the left side. It was above the median for 2 decades. So being above average is not what one should be concerned about. What one should be concerned about ultimately is on the next page, which is earnings. And if you look at the 3 blue bars in the middle, it basically says the consensus earnings Wall Street is expecting over the next couple of years is 30% higher than now. And the reason this is happening is because if you're manufacturing widgets and you cannot keep up with demand, what do? You raise the price. So your profit margin goes up. And so long as people are still willing to pay the higher price, profits are going to be really good. And ultimately, if you look at the next page, the blue line is capacity utilization. So what you see is that at below 80%, the production of widgets and other things have a lot more capacity to produce more widgets. Look at what's happening to the profit margins. They get to produce less, use less capacity, and their margins increase. Right? Because people's income are still growing faster than price. And so long as people grow faster than price, you don't have to change your behavior. When you start to decide you're going to change your behavior because the prices are growing faster than you, that's when we're going to run into trouble. But it's not going to be right now. Partially, it's besides all the people working that I talked about that's going to have more money, it's the old people that are happy. Because if they're on Social Security, they got a 20% raise over the last 4 years. Because their Social Security went up by that. And this is the group that hoards cash. They've been sitting on $10 trillion sitting in the bank for a decade and they earn nothing. Now they're earning 5%. They are so happy. For all the people that believe this money will leave the bank and come to the stock market because the market's been good, they've gone from 0 to 5%. They are happy. And because the boomer generation has over 60+% of all wealth, and they know time is getting shorter, they're spending. And so long as people spend money, the economy should be fine. And profits should be good. So we'll see what happens, but it's not this year you gotta worry about. I think you gotta worry about the longer term inflation and see what happens to inflation. Because if rates continue to go up, there are just certain industries that get hurt a lot by rising rates. And as that if those continue to suffer, it's going to get ugly. It'll take time, so it's not now that one needs to worry, but there are worries, and basically the thing to watch right now is inflation and government spending, because we cannot sustain this type of debt for like ever. Something's got to change. So we'll see, but right now things look okay.